Welcome to the Maryland Mortgage Rate Weekly Mortgage Market Update for the week of May 12, 2014. Hello, I'm John Thomas with Primary Residential Mortgage, here to give you an update. Last week was a great week for mortgage rates. They hit record lows we haven't seen since October 2013. If you look at the bond chart on the screen, you can see on Thursday we hit that record high for the bond, which was record low interest rates. And if you look the last 3 weeks, mortgage bonds have been moving higher, moving interest rates lower. Now, with that in mind, if you've hit some of the lowest rates all year in 2014, we are going to recommend locking in your interest rate short term if you're closing the next 30 days. Take advantage of these record low rates because we could see traders locking in some profits like we did on Friday, and that means rates could move higher short term. So lock it in. That's our recommendation. Now let's look at what's going on, because we've been predicting mortgage rates to move higher in 2014. They've actually moved lower. So what caused that? Well, a couple different things. The Feds, the reason why we're predicting rates to move higher is the Feds have been buying mortgage bonds for the last couple of years, $85 billion a month in their asset program, but they started tapering by $10 billion every time they met. So now in May, they're down to $55 billion. The goal is to be at zero at the end of the year. So as that happens and they pull their demand out of the market, we should see rates move up. But the reason why there hasn't been much effect on rates is they've been pulling back their demand. The supply, the number of mortgages coming to the market, has drastically dropped. Mortgages are down 55% from last year. So we haven't seen that. But at some point, as that demand keeps pulling out, we will see it affect the supply-demand ratio. The other thing helping mortgage rates reach record lows for the year is two things: tensions overseas and the stock market rally pulling back as traders take profits. So overseas, we've got Russia and Ukraine fighting. That triggers the safe haven trade. That means people pull money out of the stock market into the bond market because they're weary of how these overseas issues can affect the stock market. And then the stock market's been on the tear, so they're naturally taking profits. The saying goes, sell in May and go away. So that's been going on. So that's why we see the rates hitting record lows for 2014, but it won't last. So take advantage of it. Lock in your rate for your refinance or your purchase. Now, in economic news, we had the weekly initial jobless claims come out on Thursday, and they actually dropped 26,000 claims to 319,000 from 345 the previous week. So that's good news for the labor market. That can continue. That's a great sign there. And we also had the Federal Reserve Chairwoman Janet Yellen report to Capitol Hill on Thursday, testifying on the state of the U.S. economy. Overall, she was upbeat except for the housing sector. Said it did give her cause for concern. It's been recovering since 2011. But it's been a disappointment, she said, this year. The recent flattening out in housing activity could prove more protracted than currently expected, rather than resuming its earlier pace of recovery. That was her statement. So she's worried about what's going on. One of those reports that has got her worried is the CoreLogic Home Price Index, which came out in March 2014. It was up 11.13% from March to March, and home prices increased 1.4% from February 2014 to March 2014. But it's down from 11.81% from February to February. So the trend has been, we've got appreciation continuing, but it's slowing. It's being less than it was year over year for each month. Which we predicted. We said the housing market couldn't continue at its rapid pace, but it's still appreciating, just not at the same pace. And part of the reason why the appreciation rate is slowing is we have tighter credit standards in the mortgage market, and we've got limited inventory, which is slowing the appreciation of home prices. We also saw a report from RealtyTrack reported that cash buyers of residential properties in the first quarter of 2014 was 43% of all sales, which is more than double the cash borrowers in the first quarter of 2013, which is only 19%. This high percentage of cash buyers could potentially show a soft underbelly of the housing market recovery, because cash buyers is not sustainable. This is investors jumping into the market to buy properties, buy and hold, and take advantage of the rental market. What we've seen is home ownership has actually declined over the last couple of years. It's down to 64.8% of people own their homes in the first quarter of 2014, which is a 19-year low. Some people are seeing this as a big problem because a lot of the younger generation is still staying at home with their parents. We've got a huge proportion of renters. We haven't had this many renters since 1995. But I think it's a good sign, because if you look at 1995 to 2006, what did the housing market do? Kept going up as people moved into home ownership. So I believe this pent-up demand of renters and these younger borrowers living at home with their parents are going to start moving out, buying homes, because they are a good investment. They're going to see these appreciation rates in the market and say, hey, my money's safer there in a house than in the stock market, so they're going to take advantage of this. So I see it as a good sign for the housing market. Now, in the local news, we got the next free first-time homebuyer seminar is Saturday, May 24th. That's in Towson, Maryland, at the Baltimore Sheraton North Hotel from 10 a.m. to noon, right there on Delaney Road. You can register for that event by giving us a call in the office, 410-412-3319, or you can register online, www.marylandhomebuyerseminars.com. Look forward to seeing you guys next week.